My name is Dan Weiskopf. I am the ETF professor, and this is the ETF Think Tank. And we're thrilled everybody's here, and thrilled that Jeffrey's from Bloomberg is joining us today. We're going to be talking about REITs. So it's live at 5, as we like to say. So with that, Dan Weiskopf, lead ETF strategist for the ETF Think Tank, and of course the ETF professor and co-PM of Block. So with that, I'm going to hand it off to David, and you can run with it from there. And I see Cynthia coming on right now too, or at least she's kind of on.
Cynthia's traveling, so she's listening from
Yeah,
a car.
I'm listening. Yeah.
She's always there.
I'm always there. Yeah.
All right, David, why don't you go?
Yeah, how's it going, everyone? David Jacansky, fellow PM, the Title Financial Group. Super excited to learn more about the REIT market from Jeffrey. I'll pass it over to our chief cat herder, Mike Venuto.
Hey, folks.
Yeah.
Mike Venuto here. I'm the co-founder and CIO of Title and the Think Tank and all this fun stuff, and chief cat herder, as David said. Excited to be back. A little summer break there because nobody was around to listen to us. So I'm glad to see so many of you come back. Always help retweet this, get people invited, let them know that we're doing these things. We do like to celebrate, right? This was the result of our virtual happy hour in response of March 2020 when we all got locked down, and we've kept doing it, and we've gotten some amazing guests, amazing content over the years, great discussions. We do like to have that celebration word. Today it's going to be capital, so have a drink with us when we say capital. What else? If you've got a question, you can put it in Q&A. If you want to be promoted up, hit me up in the DMs. I'll start promoting up the ones of you that I know usually like to come talk to us. Chat us your questions and we'll get you an answer. And with that, I'll introduce Jeff from Bloomberg. And Jeff, tell us a little about yourself and what you do at Bloomberg.
Sure. Thanks for having me on, guys. Excited to do it. My name is Jeff Langbaum. I am the Senior REIT Analyst at Bloomberg Intelligence. Our team covers most of the different REIT sectors in the investable universe. I have been covering REITs for a total of probably almost 25 years now. Spent the first half of my career on Wall Street and the last 10 years or so at Bloomberg, and excited to answer whatever questions you have about REITs and commercial real estate.
Awesome. So let's start off by getting some context from you, Jeff, on what the marketplace looks like for REITs, both from a geography standpoint as well as industry standpoint, because there's a lot happening. So let's set the bar.
Sure. I think that if you focus just on what the financial news is telling you, you would probably think that the entire commercial real estate world is office buildings and it's all going to zero and there's no capital available for property owners, that nobody's lending, nobody's willing to invest. And what does that mean? And and that's true to a degree within the office space, but that is a far cry from the overall picture on commercial real estate and REITs. And if you look at asset classes like industrial warehouses, demand is still through the roof, and the buildings are doing well. If you look at apartments, you could make an argument that we're off the peak and the growth isn't as strong, and maybe supply is coming, but you're still in an environment where rents are growing for the most part, and especially in markets like New York, where housing costs continue to go up. So things aren't it's not the negative CRE story that you would be led to believe. And then senior housing, which is another asset class I cover within the healthcare REITs, they are in the midst of a huge snapback from the depths of COVID, and with occupancy rising rapidly and rents rising rapidly and inflationary pressures easing, and so they're growing like crazy. So it really varies across the board. Office is probably where we're going to spend most of our time today, and but even within office, the story varies. It's not a one size fits all type of situation. So that's on the property side. Share prices, REITs took a dive in call it early this year. The situation, and especially office REITs, but the situation with the Silicon Valley Bank, and the fears that you would not have lending in the commercial real estate world really hit the stocks hard. There's been a bounce back, and the question really is now, have stocks overcorrected? Have they come back? Where are REIT shares in relation to property values? And the problem with figuring that out is that it's very difficult to ascertain what property values are, because properties by and large aren't trading. And so that's kind of where we sit right now, in the middle of trying to figure that out.
Well, let me, David, before you launch in, properties are not trading, but valuations are where relative to perhaps debt issues too, right? Because some of these companies have to refinance their debt over the next couple of years or sooner.
Right, so it's really hard to answer the question about property values, because you have such a wide spread between the bid and the ask that sellers, someone who is looking to sell or refinance a building isn't going to capitulate until they have to, and buyers are not willing to pay the prices that sellers want, because they're looking at where interest rates are and where that means cap rates should be. And lenders are looking at, the properties and saying, okay, well, we know values have come down, and property owners like, what do you mean property values have come down? I'm still holding out for X. And until whatever that X is, until there's an actual transaction, whether it's a sale of a property or a refinancing, it's very hard to figure out exactly where property values have moved to. I think that you would be crazy to say that they haven't come down, but it's really hard to know how far they've come down. Capitalization rates, does that count? If okay, there you go. It's really hard to know exactly how much values have come down, but they have. And Blackstone says they haven't come down. Well, Blackstone only owns the best assets, of course. So we can talk about that, the private REIT situation. That's kind of a separate conversation.
I think we can get there.
Yeah, we'll get there later. Go ahead, David.
Yeah, I wanted to add on to one of Weisskopf's questions. So obviously there's the good, the bad, and the ugly, and valuations have come down across the board. But I think what scares me the most is even if you're the good, right? Let's just say you're an A or a B, right? Best case scenario, let's say your price is the same as it was a couple of years ago, right? If you're hitting a debt maturity, you still have to roll over your debt. And at these rates, they're still going to make you fork up more capital. So you kind of have to buy the building again. You're hey, I know 15 years ago you put 20% down, but you got to put 15% down now at these prices. So these real estate holding companies still have to the ones that were operating good had leverage margin to be able to maybe withstand this, but how does that look? Is there this same debt maturity wall that you see in the overall high yield market, in the REIT market? I imagine it's the same thing where they're just wake up in the middle of the night to list to ghosts of higher for longer being please no, right? Higher for longer is the worst thing that could ever happen to them, right? They're just praying this thing ends.
Yeah. So the answer is yeah. That phenomenon is happening across the board. REITs are going to be less affected by it than kind of the broader property universe, because they tend to operate with less leverage than at the overall portfolio level than private real estate investors. They tend to be better capitalized. They have better lending relationships, better access to capital, and so maybe better positioned to withstand the issues you're discussing. One of the things that we're going to see happen is even a building where if you have a building where the leasing is still solid and the rent roll of the building is still solid and the cash flow is still solid, if you had call it even a conservative 60% LTV asset, if the value of that building has fallen, I don't know, even 15 to 20%, now all of a sudden you need to refinance that loan in order to keep it a 60% LTV. You're not paying off your entire previous mortgage, and so
You got to buy the building again almost.
You either need to put in incremental capital, you need to walk away, and we're seeing that happen on the lower end of the spectrum, or properties where there's the leasing isn't holding up, or you need to find some third party provider of mezz debt. And we are seeing a lot of distressed capital being raised, and that distressed capital is going to end up being put to work somewhere. And I don't think it's going to be put to work in ancient buildings that are unleasable. Those buildings are going to go away or become something else. That distressed capital is going to be put to work in the better buildings that just need improved capital stack. And whether that means buying a building at a discount at some deep haircut, or whether it means providing mezz capital to some the existing owner who needs to come up with additional equity, that's where that's going to go. You're also seeing it on developments, right? Then this is really more of an issue in the multifamily side, where you've got a significant amount of new properties under construction, and the world has changed, and private apartment developers are going to be in need of capital. And that has to come from somewhere. And in that instance, REITs may end up being the provider of kind of a takeout equity or some sort of lend to own scenario, where they bail out a developer that's struggling to get to the finish line and end up owning the property at the end of the day.
Even those, and I apologize why I scoff, like I know the guy who's on does all the podcasts for The Real Deal, and he has a whole fund that does just this, going around New York City looking for buildings that are like half under construction and trying to provide mezz debt, etc. But like, you're still talking about 6 or 7% yields, and like the Fed funds rate could be at 5.50 in like 2 months. It just like doesn't feel like is that really what they're raising all this capital for? Is a 6 or 7% yield? Like, they're not waiting for those yields. They're waiting for something much higher than that.
The question is going to be, will the properties that offer a return higher than that be something where you would want to even invest capital at all? When we came out of the financial crisis, 2009, 2010, 2011, you had a lot of this type of capital raised, and acknowledging very different scenario now versus then. But the distress never materialized on a macro basis across the board. And it's because the assets that you want to own, you can't get those super high returns on them, and the other stuff, maybe you don't want to own them at any return.
So when I'm looking at your research coverage, I'm seeing massive variability on yields. So some of the companies might be well capitalized. Maybe there's some companies, maybe not even in your group, that are well capitalized and, frankly, have long-term mortgages and are set for, good things to happen for their, for the real estate industry or the REIT industry. So 2 questions. Is there anybody out there who's got like a 30-year mortgage at 2 and 3%, like I do? And then secondly, what is the range of yield that you're seeing?
So commercial properties don't get 30-year mortgages at 2%. So no, the wave of refinancing is going to happen over the next 5 to 10, right? That's where commercial debt is. So, if we are in a higher for longer, that's all going to roll to higher rates, and better capitalized property owners are able to absorb that. Commercial real estate has worked in high interest rate environment, right? You look back, 10 years ago, REITs functioned perfectly fine in a higher interest rate, higher 10-year yield. The issue is there's going to be pain as you get there, and so we're gonna have to go through that kind of turnover as we get there. The second part of your question, when you're asking about yields, are you talking about dividend yields on REITs or okay? So dividend yields are interesting for a variety of reasons, right? So basically, REITs are obligated to pay out 90% of their taxable income. The dividend yield is effectively therefore your taxable income, and that's not always your net income, and it's not always your FFO, which is the earnings metric that we use, but your taxable income divided by your share price. Taxable income, the income that these companies are generating, given the length of the leases, doesn't always react as fast as the markets react. The share prices, they react real time because that's what equity markets do. And so in many cases, dividend yields spiked because the dividends were still elevated. They're still paying significant cash flow, but the share prices took a beating. Some asset classes, companies are still raising their dividends. Earnings are still growing. Apartment REITs are all raising their dividends still because their earnings are growing, not as fast as last year, but you have a cash flow cushion on your payout, and you can raise your dividends, send a positive signal to the market, and so we're seeing that there. Office REITs are, their cash flows aren't falling as fast as the stock price would potentially have you believe, but office occupancies are lower, office rental rates are not growing as fast, and so cash flows are declining. And in some cases, we have REITs that are at least temporarily paying zero dividend and paying zero and therefore zero yield. Vornado, which is a New York City office REIT, earlier this year decided to suspend its dividend and didn't pay a dividend in the second quarter, isn't going to pay a dividend in the third quarter, and at the end of the year they'll look at where their cash flow is, and if they have to make a dividend payment to comply with the rules, they will. And then you layer the next piece of kind of the dividend thought process, which is liquidity. Is paying cash to my shareholders the best use of my liquidity when I might need that to deal with debt maturities? I might need that to deal with finishing development projects that are far enough underway. And so the other possibility that we might see is paying dividends in stock instead of in cash. So your yield will be what it will be, but you're not collecting any. It's not cash. It's just incremental stock. Dividend yields. We do an analysis quarterly of dividend yields versus the 10-year. What that spread is. And that yield spread has tightened significantly because the last couple months we've had a nice little snapback in REIT share prices. We've had some REITs that have stopped paying dividends temporarily, so yields have actually come back down some, while the 10-year has continued to go up. So the yield spread is actually tighter. The REIT yield spread is actually tighter than it was early part of the year.
And actually, I was going to comment on that because you mentioned REITs have done well in a higher interest rate environment in the past, but that comment you just said right there is really the difference between this time and that time, is that like the spreads had room to compress, whereas the spreads are minuscule right now. And also like, well, what, regardless of what you feel about Kathy Woods, like her comment of like interest rates being more a multiple of how many times it went up, and we're like at like the 10-20x range, like for it being at that level for 10 years, like that's such a bigger delta to what the entire real estate market got used to. So like, can they still perform in that if those spreads to 10 years are so low? And you know, you've had a 10x 20x on the short-term rate, and you know, no one ever envisioned this world. And you know, the 10-year, even if the short end of the curve doesn't move any further, the 10-year could go another 1% up, right? Like, and that's actually going to affect that even further, more so than the actual short end, right? So I don't know. It feels like we're all just begging for rates to go down to 3% or else.
So the comment that I made about real estate, can function in a higher rate environment. REITs obviously do better in a lower rate environment, and they do better when rates are going down than they do when rates are going up. I mean, that's there's no denying that. And you kind of, it's the change and the move that is a bigger issue. And then once you get to where you're going and everything, and then you kind of have that period of settling out, when we can when we'll get to to see how the properties perform, how the recapitalization of the properties happens, and then also how the REITs trade. But to your point about waiting for or hoping for that 3% 10-year to kind of be able to everything go, otherwise we kind of have a bloodbath. I think that you have a lot of people that are hoping for some kind of turnaround on rates, because they not only for the share prices, but just anybody who is dealing with a refinancing, like you can extend all you want, and lenders probably are going to want to extend because they don't want to take back properties, but at some point something has to change. And hoping that rates come back down is an obvious thing to hope for. It certainly doesn't feel like we're getting there anytime soon.
So that leads me to my next question, which we talked about pre-call, which is absorption rates. And I'll do a really bad job of defining it, and then hopefully you can clean it up. But it's like with every drop of interest rate, like what is the increase in supply and demand? In this case, in like a specific asset class of real estate. And so like, okay, we're in a world, rates are at 3%. What does that mean? That means unemployment rate is like a little bit higher, right? Like I foresee that being a world where supply actually surpasses that increase in demand because of that rate, because there's got to be a lot of pain between now and then. So what is absorption rate, and like what is your view on absorption rates like in this world if we do get down to 3%?
So I'm not sure that there's a great definition for how to think about absorption rate, but the way I think about it is this. There are a lot of different things that go into residential, and I assume you're talking mostly about residential, but there is a because that's really where the supply is, but there's a significant there's a lot of different things that factor into demand for space. And it's not just jobs, it's also, so when you're talking about residential, it's also housing alternatives, right? And if the single family for sale housing market stays the way it is now, when, even people who want to buy a house and are willing to buy a house at these rates can't find anything for sale, because Dan's got his 30-year 2% mortgage and isn't willing to walk away from it. That bodes well for a rental landlord. And even if you're in an environment where, the economy might be softening or rents are getting to the point where things are, affordability is a little tougher to handle, you still have situations where people, they need that residential, they need something. And so, I think that can help. So, there is, that can help sustain the demand. We talked a little bit beforehand about supply. There is a wave of supply that is under construction and going to be completed in variety of asset classes, but apartments is the most extreme. You've got a big wave of supply, especially in Sunbelt markets where it was so strong in 2020, 2021, when everybody was moving there, that developers just decided to start whatever they could. That stuff's coming out of the coming out of the ground now, and your demand it has leveled off. And so we're seeing a wave of supply happen, but we're also at the same time seeing declines in rental residential permitting, because developers can't access capital, and the capital that they can access is too expensive, and you can't make new development pencil out. And so I think we might have a window where you're right, where demand kind of falls below supply, and there's a mismatch that leads to occupancy declines and rental rate declines. But on the back end of that, you're going to probably see supply at the same time that theoretically you get some sort of economic recovery, and you could end up in a situation where things start to look a lot better for landlords who have the wherewithal to sustain it through that cycle. REITs specifically, and I'm going to talk about apartment REITs specifically, they're sitting on big balance sheets with bank lines of credit that are untapped and cash available to them, and looking at a world where other developers are kind of unable to jump in right now and start new product. If they start a product now, if they start a property now, it's going to develop after this current wave finishes, and they may be developing into an environment where there's less new supply and potential rebound in demand. On the office side, and I apologize, keep bouncing around, but on the office side, clearly we have a major issue with under demand for office, right? There's too much existing office building for the lower amount of office demand that we're going to see in a perennial hybrid work from home type environment. But that lack of demand, it's not like, so this is the math that I use. If everyone goes from a 5-day a week to a 3-day a week, you're basically, you got 60% office, 60% of the office demand. Let's say everybody needs 60% less space, 60% of the space they used to own. You're not going to go from, every building goes from 100% occupied to 60% occupied. You're going to go from some buildings that were 100% occupied are still 100% occupied because they're the buildings that everybody wants to be in. And if there's space, someone's going to take it. And then you've got other buildings that probably were flailing along at 60 or 70% that are going to go to zero. And whoever still occupies space that previously was in that space is going to upgrade and take advantage of the upgrade. And so, what you end up with is a lack of available high-end office space. And one of the CEO of one of the companies I cover made a comment at a conference earlier this year that I found very perverse but very interesting, which was you may actually start to see brand new office buildings coming out of the ground despite the lack of demand, because there just isn't enough high-end space. And it's a very different market for high-end office space than it is for the overall office market.
Love it. You covered a lot of really good things there, Warren. I love your question. We'll get to it in just one moment. To follow up on something you said earlier, in that recovery that you're talking about. And first off, I love the comment, and it's so mind-boggling to think about, like the home developers releasing like the most amount of new homes ever, and then it just totally drying up because they're just sitting on the rest of their land, not building, which is absolutely crazy, and has to hit the cycle at the right time for it not to have any problems. That aside, in this recovery, like the 10-year won't be at that 3%. And I know we're focusing more on the commercial side than on the resi side, but the other boost to to demand I see in resi is the 30 to 40% of homes in the US that are fully paid off, who are not necessarily just the rich asset class. You could actually think of them as like, you know, a family of 6 living in a 2-bedroom in Florida that fully owns their home, can barely make their insurance payments. Their insurance going at 40% year over year. That's their inflation. That prices them out. They are actually capable of relocating in this interest rate environment because they don't have to take on a new loan. They can actually downsize elsewhere. So I do think there's more supply potential on the resi side. I don't know on the office side than people realize on the fully paid off properties, which is like in weird pockets of this country.
But those people who are selling their fully paid off home because they can, they still need to live somewhere. And if they're not going to take out a 7% loan, then they're going to rent. And so the rental demand comes from that type of, you know, situation as well. And you know, you raise an interesting so when you brought up insurance, it's going to be a big issue in some of the hottest real estate markets in the South, right? I mean, you know, whether it's somebody who owns their house and, you know, can't keep up with the insurance, or whether it's the apartment developer who can't get insurance.
Well, isn't Arizona trying to reverse engineer water coming from the Gulf of Mexico, cleaning it, and then bringing it into Arizona to actually have water for all these communities that are being built? It's like this crazy project that's going to like kill all the natural resources around it. But
yeah, and I was reading that the reason that they have their water shortage is because all of their water is allocated to something that has nothing to do with Arizona, and all of the Arizona residents are, you know, facing a water shortage because of it. But I honestly, for the life of me now, I can't remember where that water is allocated. But oh well, nice. But so yeah, so insurance is already an issue. Also on the, you know, for property owners too, right? I mean, they're facing significant cost increases if they can even get insurance. I mean, you know, premiums on for you know, apartment, you know, Florida apartments are, you know, doubling each year, and so the landlords are, you know, their cost burden, you know, their debt cost burden is going up, their insurance cost burden is going up, their property tax burden is going up. And, you know, if rents slow, then that's going to squeeze their margin. And, you know, but so, you know, it's not all, you know, rosy. There's definitely challenges, but again, I think that, you know, it's not nearly the doom and gloom that you would believe if all you did was read kind of the, you know, my Bloomberg News real estate reporter colleagues. That's all they want to write about is the world falling apart. And I you know, I think that makes for some interesting stories, but I don't think it's going to be as widespread as that.
So to that point, it seemed to me that a lot of money over the last decades, long-term money, has gone into firms like BlackRock to invest in real estate. And frankly, none of this is really a surprise to a firm like BlackRock. You know, what are you hearing in the context of how they're preparing for the refi issue? Is capital still available to them?
So
Cheers.
cheers. Um, Capital is available to certain borrowers and certain properties, right? It's not necessarily as widely available as it was. The CMBS market really isn't functioning. Banks are clearly going to pull back on their commercial real estate exposure. Life companies are, you would assume, going to pull back on their commercial real estate exposure. The alternative capital sources have a ton of money, but that's kind of earmarked towards, trying to figure out how to make their own incremental investments rather than support current property owners. The big institutional bellwethers, whether it's names like BlackRock or Blackstone or BXP or pick your large REIT, they have access to they have capital, and they have access, they have lender relationships that I think will end up protecting them, because those relationships are, there's value in that relationship. And so if you're a bank and you need to pull back on your exposure, you make sure that your relationship with BXP survives, and let some, lower tier, smaller cap, borrower relationship lapse. And those are where those are the types of borrowers that are going to have trouble accessing capital. And it's going to be the big funds, the big companies that come in and for properties where there is value that can be had, are going to kind of swoop and take that stuff, right? I mean, BXP, I keep mentioning them, they're kind of the highest quality office REIT, kind of widely considered to be the bellwether. They own the best assets. They have the, very clean balance sheet, a development business that has proven out over decades. Their probably highest profile building is the General Motors building that they got by basically swooping in and taking it when Harry Macklowe had to, deal with all his capital stack issues in 2008. And, they were able to partner up with some outside institutions and get access to debt and buy that building, which, is not the kind of building that comes available often. And, those types of buyers, or those types of investors who have the access to capital, are going to be sitting waiting in the room for those types of situations to develop. And
But
so
is that going to match, like BREIT just had $10 billion come out this year? It's going down, but at $3.7 billion request in July. Like, is that going to match those kind of dollars that are still being pulled out? Like, at some point, Blackstone has to sell a grade A office building somewhere, right? No, I mean,
yeah, I mean, and right now they're holding off doing that, because I don't know that the value will be there when if they were trying to put something on the market. So they're selling their casinos, and they're selling their hotels, and they're selling their resort investments where values have held up better, and they're able to pull out a bunch of liquidity that way. And they are able to, they've so far, it seems, been able to appease the money that's the redemption requests enough so that the volume of those requests have come down, and we'll see where that shakes out. But yeah, I mean, if Blackstone had to put an office building on the market right now, they probably would not be happy with the execution. They don't have to do that because they have other options to raise the capital that they need. REITs, BREIT is the non-traded, and they've got the redemption requests, but regular public listed REITs, they don't have to deal with any of that, right? They don't have to sell, they don't have to fund redemptions, they don't have to take write-downs on assets unless they're planning to sell something. so if they have the balance sheet and if they have the, you know, the ability to make it through, to kind of get through the cycle, they can withstand valuation decline and come back and be well positioned on the other end. The issue will be if in the middle of that, they are either forced to refi or forced to sell property, because, you know, the universe of potential buyers and potential lenders is a lot less than it was, and it's a lot attractive than it was.
We have a couple questions on the international REIT side, so I'll switch that in just 1 second. But who are the buyers of these resort assets? Is there one centralized buyer? And then I don't know if you feel comfortable. We've had a couple questions on both Canadian REITs and international REITs. If there's any stocks that you cover there that you could give us some ancillary thoughts on what's going on in those markets, but you might not be able to.
Yeah, so unfortunately, my coverage is entirely US, and so I don't spend a lot of time thinking about properties and companies outside of the US. We, as a research department, I have colleagues in our London office who cover the European sector of the universe, and in our Hong Kong office who cover some of the Asian properties, and the biggest difference that I see, the performance of the assets is similar, the performance of the capital markets is similar, everyone's going through a lot of the same issues. The bigger difference is the accounting that REITs or REIT-like structures in those markets, they mark their portfolio to market on a either quarterly or semi-annual basis, and so they're consistently, the valuations of their properties are much more known than here, and so that's a big issue that my colleagues are thinking about. But beyond that, I haven't really dived in. Look, I know the companies that own office buildings in London and in Hong Kong are going through a lot of the same issues here. They're not, it's not always exactly the same. The cycles are not exactly the same. The work from home is not exactly the same. The demand and the supply is not exactly the same, but it's a very similar dynamic in terms of downtown, office real estate. I can't remember if there was another piece of that question. And I apologize that I don't have a great handle on the international side, but you feel free to have one of my colleagues from either London or Hong Kong come on. They are much more aware of that and happy to talk about it.
Eric, do you want to answer or ask your question directly? No, he doesn't. So I'll ask for him. What is the financial health of sponsors of non-traded REITs like Franklin Square?
So that's another piece of the universe that I am just not nearly as in tune with. BREIT, it's all the headlines because of the size and because of what is happening with their redemptions, and same with the Brookfield and the Starwoods. The others that are in the space, I'm just a little bit disconnected from, because they don't bump up against the companies that I spend all of my time focusing on. I don't know. I really would hesitate to even want to fathom a guess in terms of how what the financial well-being of the sponsors looks like. My guess is that and in a high interest rate environment, anything that's being pitched as a yield alternative, a lot less attractive than it was a year or two ago. And if that's kind of the primary capital raising mechanism for those types of investments, then you're probably not feeling great right now. In terms of the assets that they own, I don't have a handle on exactly what is owned, but you're going to be subject to a lot of the same issues that we've already talked about in terms of the overall property universe. To the extent that these are, higher yielding properties that maybe were a little bit riskier property from the beginning, they may be in a little bit worse shape, and whether or not they have access to lenders and access to incremental capital, to get through this next couple years worth of debt refinancing. I don't have a sense, but my gut is that they're probably not as well positioned as the bigger institutions.
And honestly, that's what I don't understand about these huge pools of capital, like what yields they're waiting for, because spreads are still tight, yield curve less so, but it's still inverted. Comparison to a money market is not that attractive. But I guess to go back to an earlier question that Warren asked, to circle back to a conversation we had prior to starting, I was like, let's talk office conversions and what that actually takes. Because, you said there's A, B, C, and D properties. A, such limited supply, there might actually be more necessary, but the C and the D, people are trying to figure out what to do with. And my first question to you was like, bathrooms, right? There's like 2 lines of bathrooms in an office building, and you need a lot more for residential. What else do you need when you're considering these transitions?
You need cooperation from the government, which is always going to be a hassle and going to be a cost and going to be a going to lead to an extended time frame, even with stuff going on in New York, where the mayor and the governor are clearly trying to be helpful. It's just it makes for a very complicated transaction. So you have that from a structural construction beyond the bathrooms. I mean, it's been widely discussed that depending on the type of office building, if you've got a big floor plate with a center core elevator, how do you fit more than one apartment unit between the center core and the external wall? So there needs to be kind of a structural. They need to figure out structurally what can and can't work. I mean, it can be done. It has been done. I mean, obviously downtown Manhattan has a number of office building or apartment buildings that used to be office buildings. The older,
those are not cheap buildings. Those are expensive buildings to live in.
Right. Well, and so that's the other thing, right? Is if you're talking about this as a solution to a affordable housing crisis, then you have to layer on the economics, right? And if it's an expensive transaction, both to kind of get access to the property, make the do the work that needs to be done in order to convert, and then deal with whatever the affordable housing component is. How do the economics work? What is the city going to be willing to give in terms of tax incentives or whatever to make it appealing? It will happen. It will happen slower than kind of pure market theory suggests it should, which is if you have too much office space and not enough housing space, turn one into the other. I mean, it just won't happen that rapidly. Some of the older, smaller buildings may be the easiest to convert. Kind of loft style type stuff. That those conceivably could be some of the first office buildings to maybe become obsolete as office buildings anyway. And so we'll probably see that. I know the mayor's office the news from the mayor's office with the attempted rezoning of a certain part of the city, right? I mean, we'll see how that shakes out. I definitely think you will see some of it. It won't be the panacea that everyone's hoping for, that immediately solves 2 problems, but you will see some of it.
Are there certain here in the U.S. certain regions that are stronger than others?
So yeah, well, I'm going to flip that question and talk about markets that are weaker than others. I mean, so look, so San Francisco is a major problem right now. for a multitude of reasons. And they got a little bit of a reprieve with AI when the kind of AI was all of a sudden the new solution to office demand and residential demand and everything, VC, everything. I don't know if that's sustains at that level. I don't know exactly, how that plays out and over what time frame. But San Francisco's a problem, and San Francisco is a big market for REITs, both on the residential and on the office side. And it's going to take a lot to get that market turned around to the point where people want to visit there, people want to live there, and people want to office there. And so that's one area where I would definitely highlight a risk. But the caveat to that may be tech companies getting a lot less willing to let people work at home all the time. We're seeing in Seattle with Amazon's pulling everybody back into the office, a little bit of a rebound in kind of office and residential demand, because now all of a sudden people who could just work from anywhere need to be near Seattle again. And so you might see some of that. New York, we talked about kind of what the office environment looks like here. The residential, I think, is still through the roof on rental demand. So that's a market where I think that, if you're talking about different asset classes, the answer is going to be very different. But clearly there's strength on the residential and concern on the office. The entire Sun Belt is kind of coming out of a huge boom cycle because everybody wanted to move there. All the companies wanted to move there. All their employees wanted to move there in 2020, 2021, 2022 even. And I think that they're ripe for a little bit of a pullback on demand, but also subject to some supply problems because real estate developers have always operated the same, which is they overreact to changes in demand, and then you end up, especially in the Sun Belt where you can build anything anywhere, you end up with an oversupply situation. So I think that we might be in for that there. And then one other city that I would kind of highlight is Miami, Florida, which is the hotbed of everything right now. And until all of the coastal assets fall into the water, the demand is through the roof, and developers are going to follow that. And it's a very different market. But what's interesting, and I've written about this, is that there are no office REITs that own assets in Miami or have started developments in Miami. I guess it's not a market where they have gotten comfortable yet. I make the connection to office developers who were frequently in San Francisco and very focused on tech, who eventually took the plunge and moved to Austin. Office developers who are in New York and who are losing their financial tenants to South Florida may at some point decide to build down there. But right now it's mostly private real estate developers who are taking that plunge. And we'll see kind of how that shakes out. But so it's different. Every market is a little bit different. Every asset class within every market is a little bit different. But hopefully that kind of helps answer your question a little bit.
Hey, Eric Connolly, you got another question? You're muted, my friend.
I do. Tagging on to the end of that response, why haven't coastal properties seen a bigger decrease in value? As I was getting onto the ferry this afternoon, there were sandbags for the hurricane that's going to blow by, but it's clear that insurance is just killing any person by the coast, and I imagine the office buildings too. Why haven't you seen the cap rates just skyrocket?
And I think this comes back to the comment at the beginning that there's just a lag, because my guess is the cap rates have skyrocketed. it just, you wouldn't know it yet because buyers and sellers can't agree on where the cap rate actually is. You know, the coastal location isn't the only determinant of that, right? I mean, obviously insurance costs are up, demand is also strong. So you've kind of got, you know, maybe your margins are holding up a little bit better, even despite the higher costs. I you know, don't think that real estate buyers are yet willing to write it, but beyond the insurance costs, I don't think real estate buyers are willing to underwrite, you know, climate risk fully yet. But I think that if a seller is forced to sell, and I'm not talking about residential homes because I just don't know that space well enough. And, you know, from people that I know in Miami and on the water in Miami, they have no problem selling their homes. So maybe just a completely, you know, different type of economic environment. But, you know, if an office owner in a city like Miami right now was, you know, forced to sell a property, I guarantee you that the value that they would be holding out for, they wouldn't get. And so cap rates would just naturally tick up as more deals close at higher cap rates. Right now, such limited transaction. I mean, if you look at the transaction volume on commercial real estate, we are at all-time lows. And it's simply because buyers believe one thing and sellers are holding out hope beyond hope of something else. And the reality may be in the middle, the buyers may be right, but it's definitely not where the sellers are. And until you're forced to sell or forced to refi, where you actually need somebody to come in and tell you this is what the value is, take it or leave it, you push that can down the road as long as you can and pretend the valuations haven't changed. The Blackstone, the B REIT model, the valuations haven't changed, right? They haven't changed because you haven't had to sell something where the value changed.
So we're at the top of the hour, and Jeff, you held up well. We were kind of grilling you, I felt like, and I hope you come back.
I held up well because I stayed away from drinking alcohol during the hour, but I will I will pop open my my hot take IPA. So hopefully that matches the hot takes that I presented. And yeah, you know, if real estate remains something that you want to talk about, I'm happy to come on and talk about it.
Well, it's out there, and it's an important sector industry to the economy. So we're always going to be, you know, asking lots of questions about it. Thank you, everybody, for joining us for this happy hour. With that, I think, unfortunately, we will conclude.
Yep, folks, we're actually going to take next week off because the entire title team is getting together in Milwaukee to talk about. We've moved our headquarters to Milwaukee, by the way. I never thought I'd own a company with a headquarters in Milwaukee, but the real estate's just too much here in New York. But we're taking the whole team to get together. We're actually having a party at the Harley Davidson Museum. So we'll miss you next week, but then we'll be back and coming. I think after that, I think we have Jerry Parker coming on, the famous, yeah. And he recently did an ETF with us. That's a hell of an innovation. So that, if you've never heard Jerry speak, it's like the Warren Buffett of commodities. Like it, and he's so unassuming. It's a very good discussion, but maybe not as good as Jeff.
Hot take.
Hey, protect your capital, and we'll see you next week or in 2 weeks. Thank you.
Thanks, everybody. Bye-bye.
Thank you.